Economists are a mix of cowboys and astrologists. They have the recklessness of cowboys combined with the science of astrology. The discipline of economics is presently so blinkered by the fetish for mathematics that theories go overvalued and unchecked. This probably explains the reason why some economists are entertaining the idea of a V-shape or a U-shape recovery. In this video, I will look at how economists are predicting the US economy will recover from the 2020 pandemic-induced recession. I'll try to explain why a V or U-shaped recovery are simply lazy explanations of how the US economy will react. I will instead propose the idea that a K-shaped relapse is a better predictor. A V-shaped recovery is rapid and seamless for an economy. The V-shape resembles a V when placed on a chart for a variable such as GDP. A V-shaped recovery is a best-case scenario given the recession. A U-shaped recovery is similar to a V-shaped recovery, except that the economy spends a longer time slogging along the bottom of the recession rather than immediately rebounding. So, would it be weird instead to think of the American economic reaction to the recession as a K-shaped relapse? Yep. Well, yeah, it would. There's no denying that it is sort of weird, but will you entertain the idea for 2 minutes? Cheers. So let's look at what a K-shaped relapse really means. This current recession will bring about a host of unique issues affecting different income brackets, age groups, and social bands variously. This K-shaped relapse proposal acknowledges the US economy will not react universally to this recession. A relapse, by definition, is a deterioration after a period of improvement. The US economy has improved in terms of headline metrics in recent years, even if these improvements weren't fully distributed equally. Back in February, the US economy can be seen to be at the starting point of the graph, where GDP is some ridiculously high number and time is at zero. In reality, different groups of society are at different points on this axis. For example, the top 1% of wealthy will be higher up the GDP axis than the bottom 50%. We will simplify and speak in the language of an economist and act like the economy was in equilibrium. Economic well-being does not initially diverge into a K-shaped relapse. This is due to the US government and the Fed helping the economy. In this recession, it has come in the form of increased unemployment benefits and mortgage forbearance. This aid from the government will not last forever, and it is after this stage when the effects of the recession will have complete asymmetric effects on different groups of society. This logic of the top 1% of the population in terms of wealth splitting from the bottom 50% follows on from a study done by Thomas Piketty, Emmanuel Says, and Gabriel Zuckman, where they argue that the rising share of the top 1% of earners has come at the expense of the bottom 50%. It follows that if the top 1% have not done as well, someone else must have done better. Maybe they're being a bit dramatic, but I find it more believable than the trickle-down economics school of thought. So, here are 3 quick, non-exhaustive reasons why the K-shaped relapse is a more appropriate way to look at the future of the US economy. Firstly, how a recovery is measured. Most reports on an economic recovery use the stock market, GDP, or unemployment levels as a yardstick for how the US will recover from recessions. The stock market has improved from its low in March, but it doesn't really tell us anything about the lives of people. How about we look at more specific relevant data? The inequality in economic growth and its asymmetric benefits are more prevalent now than ever before. As we can see from the below, different income brackets reflect differently to recessions. The richest families are the only group to have gained wealth since the Great Recession. The wealth gap between America's richest and poorer families more than doubled from 1989 to 2016. In 1989, the richest 5% of families had 114 times as much wealth as families in the second quintile. By 2016, the ratio had increased to 248, a much sharper rise than the widening gap in income. 248 times. Now that is huge. We can surely see that the recovery for the wealthiest in the population is a relapse for the weaker sections of the population. When thinking about an economic recovery, we need to stop pretending that all financial benefits in GDP are shared equally amongst the US population. A second reason supporting a K-shaped relapse is current debt levels. Government heads should not resort to traditional approaches of austerity and anguish to band-aid this problem. Central banks such as the Fed should be passing on lower interest rates to consumers, which to be fair has been happening in the US. The average rate on the 30-year fixed rate mortgage is at its lowest rate in 50 years at below 3%. This is helpful across the board for Americans, as it can help the population refinance their home and reap savings. But these low rates mean nothing if consumers can't get access to credit. This could be the old story of those who need the lowest rates the most won't actually be able to get them. For example, someone who previously had an old credit blemish might not be able to get access to these low rates. When looking at low rates, we also have to look at the CARES Act and forbearance. The CARES Act allows borrowers with a federally backed mortgage to get forbearance relief for up to 180 days without the need to show proof of hardship. After 6 months, they can ask for an extension of up to another 180 days, bringing the total forbearance period to a year. More than 4 million households have already entered forbearance programs, which is about 9% of outstanding home loan mortgages. The biggest benefit of the CARES Act is a pause or reduction in mortgage payments, allowing many Americans to catch up financially during tough times. However, there are some potential huge issues. Missed payments will add up during the forbearance period and must be paid back. It's a short-term solution, so it won't be helpful if you're having trouble paying your mortgage in general. In some cases, you may need to make even bigger monthly payments once you start paying again. You may even have to make a lump sum payment to pay it all back at once. Forbearance is undoubtedly needed to avoid and reduce default on home payments and prevent leaving people homeless. However, there needs to be additional emphasis put on education by lenders on the implications of availing of this service, as it can leave some households worse off in the long run. The third and final point in favour of a K-shaped relapse is the phasing off of payments, causing an income cliff. A recent study done by Peter Ganong, Pascal Noel, and Joseph Vavra of the University of Chicago showed that recent spikes in spending data in America is largely influenced by the fact that nearly 2/3 of Americans have got more from state-sourced income during the pandemic than when they were while working. This uptick in economic spending will not last forever. Powell has pumped up lower income household spending and helped them to pay for essentials, and thus their spending is only marginally below pre-COVID-19 levels. When these subsidies dry up, jobless benefits will revert to their typical pre-pandemic levels, low by design to encourage people to look hard for work. In a sign of how weakened the job market remains, more than 1.4 million laid off Americans applied for unemployment benefits in the last week of July. It was the 19th straight week that more than 1 million people have applied for jobless aid. Before the coronavirus erupted in March, the number of Americans seeking unemployment checks had never exceeded 700,000 in any 1 week, even during the Great Recession. The government says roughly 30 million people are receiving some form of jobless aid. This is double the 17 million officially unemployed based on the jobs report. In the US, you have to be actively looking for work to be classified as officially unemployed, but you don't need to do so in order to claim benefits right now. Hence, the 11% figure is grossly understating the true picture, vintage from Economists framing data. The pain of the poorer Americans could intensify. A supplemental $600 in weekly federal unemployment benefits from the CARES Act expired at the end of July. The expiration of the $600 in federal unemployment aid means that many households could suffer a loss of income in the range of 50 to 75% when the new act is officially decided. That could further weaken spending, thereby fueling a downward economic spiral. On the small business front, the National Federation of Independent Businesses reported 14% of members that took advantage of the scheme are expecting to fire staff in coming weeks, given demand has not returned to pre-COVID levels. It should be clear there is an issue with relying on the stock market or GDP as standalone recovery metrics. They give a detached, lazy overview of how our economy is doing. They have their uses and are important for business and political purposes. However, they should not be dominating the blurred area of human and business success. Even looking at unemployment data is misleading unless you dig further into it. From this recession, millions of Americans' lives will be structurally changed, and the gap between the top 1% and the bottom 50% in terms of wealth will be increased further. Now look, I didn't mean to come across as a barstool economist in this video, but it seems like it is important to refrain from simplifying the recovery of the US economy after the pandemic. So how can we reduce the K-shaped relapse? A few places to start would be: give businesses credit at low rates. Avoid a credit crunch that has creeped up in possibility. This will give small to medium businesses the ability to continue. It should help instill confidence in entrepreneurs, put money and trust in businesses to reduce their anxiety of getting paid and paying their staff. Put pressure on banks to make sure they are passing on lower rates to consumers too. If these low rates aren't passed on to individuals and these rates are underutilized, the whole rationale behind a rate cut in the first place would be redundant. In addition, there is a need to modernize the unemployment insurance system and make sure that gig workers can access it. It would also be great to add new benefits like training vouchers to help those who want to transition to new jobs in the wake of being unemployed from this recession. Well, that's that spiel finished. Cheers for watching and let me know what you think.